No, you're not the only one to feel doubt and nervousness investing money when the market looks to be at all-time high. And that's because we're so used to hearing the phrase buy low and sell high. But the reason why this phrase is so popular is not to do with our investment strategy, but because our human psyche is quite flawed. I mean that we feel and act differently to winning compared to losing. A renowned psychologist, Daniel Kahneman, have found that we feel twice as much hurt compared to happiness when we lose £100 compared to winning the same amount of £100. Basically, our thought process is quite skewed, and we need constant reminder on a daily basis to think rationally and to not panic when the market is down. But today, I am not going to talk about how to think or how to invest when the market is down, because I think a lot has already been said about how to invest at that point in time. Instead, I will tell you how to think and how to invest when we're standing somewhere here. Hi guys, welcome back. I hope you're all keeping nice and warm. So as promised in this video, I'm not going to sell you any fears and talk about the market corrections, because you know what? Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. Okay, I did not say that, but Peter Lynch did. He's one of the most successful investors and a great stock picker. So if not me, at least hear from the experts. Basically, in plain and simple words, what this quote is trying to tell you is that don't try to time the market. And you know what? Using real world data, I will show you that even if you only invested during all-time highs, it will not be so bad. In fact, it can actually be quite positive. And not only that, in this video, I'm gonna give you 3 great simple tips and strategies to follow so that you can start to invest from here. Tip number 1, think long term. I know you have heard this before, but let's just break down what long term really means. Even before thinking very long term, let's just think about what can really happen from this point onwards over next 6 months. There are only 2 real possibilities, right? It can either continue to go up, right, like this, for example, over next 6 months, or it can go down and lose you a bit of money over the next 6 months. And given how random the stock market can really be, we should rationally give a 50% probability to an up market and 50% probability to a down market. So in 6 months' time, you would either have one of these 2 feelings. If the stock market goes up, you'd feel regret of not buying enough at this price here, because remember, this is the price which is cheaper than the price right at the top. Or if the stock market goes down, and if you still believe in this investment, you'd say, wow, this is actually quite a bargain. I can buy even more units at a cheaper price compared to how much I paid 6 months ago. So the moral of the story is there is nothing to panic about. So you can turn that frown upside down and smile. Okay, I'm not done with this point yet, because we have only spoken about over the next 6 months, which is actually considered to be a short-term period and not a long-term period. So now I really want you to think about what's going to happen to this line over the very long term. For example, over say 5 years or even more. The key word to note here is trend. What I mean is that regardless of whether you're here or whether you're here, over the long term, the trend of the stock market is upward sloping, basically like this. And sure, it can be quite volatile over the short term and it can go up or down against this, long-term trend line, but over time it actually goes up. The trend or the direction of travel is basically upward sloping. But why is that? Remember that the stock market represents the underlying health of our economy or our country. So as long as our economy keeps on growing, which it is expected to do, otherwise we're gonna go back to the old age and start trading chickens, this line is also expected to keep growing. So rest assured that over time we'll be okay. So the point I'm trying to make is always think long term. Think of the generational wealth that you want to build for yourself and your family. And don't look back. Well, in fact, don't look down. Only look forward. Caveat. This is not to say put all your money all at the same time right at this point. What I mean is that slow down, don't panic, and stick to your plan. Don't have a plan? Well, this is my second point. Please have a plan. The first part of the investment plan is to have a strategy that you can follow. Give yourself a normal market strategy and a bear market strategy. A normal market strategy could involve investing a certain percentage, say 15% of your monthly salary into the stock market, regardless of where the market currently stands. You can set this part of the strategy to auto-invest, with the criteria to reinvest your dividends every month. And for the bear markets, you can use the strategy of dollar cost average, DCA, or have an exit plan. Dollar cost average is a great way of investing, especially during volatile market or when the market is dipping. As long as you still hold a strong conviction in the investments that you have, you can use a bear market to carry on buying units in those investments at a much cheaper price. If on the other hand there is a huge shock in a certain part of your investment portfolio and that investment no longer meets your criteria or suitability, then you can apply an exit strategy. An exit strategy should really apply to a single stock holding and not an investment to the broader stock market. And that is because a single stock or a company can in fact go bankrupt while the whole country hopefully won't do the same. So how does DCA actually work? Say at this point here, you have one unit of an investment and you paid £100, right? And say in few weeks time, the market drops and the price falls to say £50, okay? So you have 100 here and you have 50 here. You still hold one unit at this point. So at this time, what you can actually do is choose to buy 2 more units of the same investment. So you will end up with having 3 units from 1. But now think about what is the per unit cost of your investment. You can do this by adding up how much you have invested over the number of units that you have. So you've invested £100 before, and plus you've bought 2 stocks of £50, so you got 50 plus 50. You divide this by 3 and you actually get £67. It basically means that you have no longer paid £100 per unit for your investment. Instead, you have paid £67. So what DCA does, it brings down the total percentage loss in your portfolio. Now, the second part of the investment plan is to make sure that you have a well-diversified portfolio. We call this portfolio construction. It basically means that you have constructed your portfolio in a way so that not a single company or a stock can dominate the overall performance of your investment portfolio. An extreme example of having no diversification would mean you hold all your money into a single stock. If you prefer to invest in only single stocks, then it is recommended to hold at least 15 different stocks in your investment portfolio to get some level of diversification benefit. Having a good level of diversification can help you avoid situations like this.
Your life savings?
Yes. I'd like to buy 500 shares of Animotion Incorporated.
Animotion! The firm declared super-duper bankruptcy, which is terrible news for the company's only stockholder, Homer Simpson.
Diversification is key when you're investing in the stock market, especially when you're investing at a point when the market looks to be at all-time high. Because guess what? Not all the stock market will be at all-time high all at the same time. For example, the US stock market could be at all-time high. However, look at the UK market. It is far from it. Say, for example, you only invest in funds and ETF. You can add diversification by investing across different geographies, styles of investments such as value and growth, different sectors, and across different market cap. For example, if you only invest in equity funds, you can start to invest a bit more in the bond fund. If you only invest in developed market equities, you can start to invest a bit more into emerging market equities. If you only invest in large cap companies, you can add exposure to small cap companies. If you only invest in high growth tech companies, you can add exposure to financials and value companies. And my third tip is to avoid herd mentality. Unfortunately, many of us are fed with constant non-stop news from these so-called money gurus whose ultimate aim is to either spread fear of a doomsday or spread false hope of this euphoria around getting rich quick. I know it is not easy, but we really need to try and cut through this noise and clear our mind so that we can think rationally. But why is this herd mentality so dangerous? To understand this, think of what happened to London's Millennium Bridge when it first opened. Stick with me on this one. I promise you'll love to know this fun fact. So the London's Millennium Bridge opened on 10th June 2000. And of course, just like any big construction, a lot of work and tests was carried on it before it was open and made safe for people to use. But on the day that it opened, when it was crossed by nearly 90,000 people, it had an unexpected vibration and started to wobble. So for safety reasons, it had to close. After much research and studies on the bridge, the engineers found that the reason why the bridge was wobbly was not due to the number of people or their weight, but the fact that all these people were moving in a synchronized manner, triggering a positive feedback cycle. Now apply this to the stock market. Herd mentality is like this synchronized movement which puts a lot of pressure on the price or the level of the stock market. And this pressure does not come in a natural way, putting a lot of force in the stock market, causing it to wobble, just like the Millennium Bridge. The stock market price is expected to reflect the underlying company's intrinsic value and not what you or me think what the stock price should be. And so when everyone in a synchronized manner thinks buy, 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 it puts some pressure on the stock market where the price keeps going up, 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 so far away from the real value that it creates a bubble ready to burst. And again, when everyone thinks sell, 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 it puts another type of pressure in the stock market, causing it to crash. So between these two real options, would you rather be on this wobbly bridge full of synchronized people, or would you rather think rationally and take your own path? Yes, it may feel scary to walk alone, but as long as you know your final destination, which is long term, and you stick to your plan, which is same as following a map, you'll do just fine. Now for the most interesting part, I'm gonna share with you some numbers and studies which will show you that it is actually not so bad when you invest in the stock market when it is all-time high. In fact, it is actually rather positive. You don't have to believe me, it is not my study, but look at what JP Morgan have found. Their analysis showed that from 1988, if you invested in S&P 500 on any random day, your investment would have made money over 1 year 83% of the times and give you an average return of 11.7%. But if you only invested when S&P 500 closed at all-time high level, you would have actually gotten a positive return 88% of the times with an average return of 14.6%. Although past performance is not an indication of future, but at least if you considered yourself unlucky to have always bought at the peak, just know this, you did better than rest of us. And what's more is that there is another great study by Bernstein, and what they found was even more incredible. They went back even further and started to look at performance from 1928. And they found that investors earned an average of 11.4% return on any given rolling 12-month period, regardless of whether the market was at all-time high or not. And if they did invest during all-time highs, they would have gotten 10.17% in return, which isn't really bad, right? But the thing that really caught my eye was this. If the investor felt cautious, like many of us are feeling right now, and waited to time the market by 3 months, so they did not invest over 3-month period waiting for the market to correct, they would have got 9.2% in their return, which is 3% less than the normal market return. And if they in fact waited 9 months to invest, they would have gotten an average return of 1.6%. See, both of these numbers are actually below 10.7%, which is what they would have gotten by investing only during all-time highs. How incredible is this? Look, to be honest, this is genuinely a reminder truly to myself first. Basically, I'm telling myself, don't worry, we got this. There is no point trying to time the market because it doesn't even work. Well guys, I really hope this video provided you with a little bit of comfort if indeed you are worried about investing right now. Do consider giving this video a thumbs up and subscribe to my channel if you haven't done so already, as I upload videos every week on all things personal finance and investing. Well, until next time, look after yourself and your money.